Okay, now we're going to dig deeper into the demand for money. To do this, we want to think about money broadly. So we're not just thinking about currency, green pieces of paper in the United States, but we're also thinking about checking accounts that often don't pay any interest, or debit cards, which are equivalent to checking accounts. Now, both consumers and firms will demand money. Consumers are going to use the money to make purchases, or possibly to pay off their credit cards. Firms use the money to write payroll checks and make small purchases. So money demanders are facing a portfolio decision. They're trying to figure out what form they wish to hold their wealth in, or their liquidity. If they hold their wealth in the form of money, well, that doesn't earn interest. On the other hand, if they hold it in bonds or other assets, then those holdings earn a nominal interest rate, capital R. So then we can ask, well, what's the effect of a higher nominal interest rate? Well, remember, money is not earning any interest. Bonds earn this capital R. So if R goes up, that raises the opportunity cost of holding cash. That's going to induce firms and consumers to substitute out of money in favor of interest-earning assets, and that reduces the demand for money. What's the effect of higher income? A higher level of income raises the real volume of transactions in the economy. Consumers and firms want to hold more money. And what's the effect of a higher price level? Well, that raises the dollar price of all goods and services, so it increases the nominal demand for money proportionately. But remember that it's the real demand for money, MD over P, that determines the quantity of goods that firms and consumers can buy. Now this should be a review for you. I'm going to link up real and nominal interest rates. Let's define the net inflation rate as the change in the price level over the past price level. So this is just delta P over P. The real interest rate then comes from this Fisher equation, where you take the nominal interest rate and you adjust it by what the expected inflation rate is over the term of this nominal bond. So where does this Fisher equation come from? We've talked about this a bit, but I'm going to do it a little more detail. Well, 1 plus R is the gross return in dollars in period T plus 1. That comes from giving up 1 unit of money at time T, which you use to buy a bond that pays the principal, that's where the 1 comes from, plus the interest, that's the R, dollars next period. Now, in real terms, to buy that bond, you had to give up 1 over P units of goods. So we're thinking about you buy a bond for $1. Okay, so 1 over P is the units of goods that you give up at time T. And then the expected payoff that you get is 1 plus R, next period, divided by what you think the price level is going to be next period. So we can then write the real return in units of goods. So this is the real return. This is the nominal return deflated by the price level next period. And this is the real value of what you had to give up to buy $1 worth of bonds today. So if you just do the simple algebra, you end up with the Fisher equation, which says that the real rate is the nominal rate deflated by the expected inflation rate. So long as inflation and the real interest rate are relatively low, then this interaction term is going to be negligible. And that then allows us to basically just ignore it, which gives us this little shorthand Fisher relation that says the real rate equals the nominal rate minus the inflation rate. And again, remember that you're actually thinking about the expected inflation rate, not the actual, because you don't know what the inflation rate will be between today and tomorrow. So this is a picture that I think you've seen, but what I want to emphasize is that there have been times in the 70s, for example, and more recently, when real interest rates have been negative. So people actually got a negative real return on these nominal assets that they were holding. So now we can ask ourselves, what is the rate of return on money? So if capital R is the nominal interest rate and little r is the real interest rate, so capital R is in dollars, little r is in goods, then what's the return on money? Well, money is a nominal asset. It's just like bonds, except that the rate of return on money, this R super M, is 0. So if we compute then what the real return on money is, we use that same Fisher relation. We take the nominal return, scale it by expected inflation, but this baby here, in the case of money, is 0. So then the real return on money is just 1 over the expected inflation rate. So higher inflation, or higher expected inflation, reduces the real return on money. Now, nominal interest rates have to be non-negative. I'm sorry, I skipped that. They have to be non-negative because if nominal rates were negative, then people just wouldn't hold any bonds. They would hold only money. But because nominal interest rates are non-negative, the real return on money can't exceed the real return on bonds. It must be the case that the real return on bonds, this R, is greater than or equal to the real return on money. So then the question becomes, if the real return on bonds is always at least as high as the return on money, why does anybody hold money? And that's what the theory of money demand is all about.